Well, good evening, everybody, and welcome back to Strongman Personal Finance. We have a explosive article from Bloomberg that we're going to be reacting to, specifically addressing the high yield dividend warrior community. And there's somebody that I recently interviewed on my channel that is actually featured in this article. So, as a all-in yield max investor myself, totally, we're going to react to this article. I'm just going to give you my honest thoughts. So buckle up. This is kind of a long article, and I hope you enjoy it. So it's behind a paywall, but luckily I'm a genius, and I was able to get access to the article and download it before the paywall went up. I don't know how I did it, but I did. So here we have this dude right here doing his little bodybuilder flex move on I guess it's a billboard outside the New York Stock Exchange. I haven't been to Wall Street. I don't know how it looks. I do plan to go up there in a couple months, but I've never actually been to Wall Street before. So we have this article, The New American Hustle, Dividends Over Day Jobs. I never knew that receiving dividends was a hustle. Okay, a hustle means implies you're doing something, you're going out, you're producing. Dividends are you buy a stock or an ETF and you just collect the dividends. Okay, I don't consider that hustling whatsoever. A financial influencer displayed at the NASDAQ market site in Times Square, New York. How do I get myself to be on this? How do I get myself to be featured on the NASDAQ? I want to be famous too. Okay. Decades of schooling, a lifetime at work, a couple years to enjoy it if you're lucky. Then it's all over. That's the deal. Generations of Americans have been sold for more than a century. Yes. You want to know why? Because Americans are told to save on one hand, and then they're also encouraged to be consumerists on the other because that juices corporate profits. So it's a dichotomy. Are you supposed to be a saver? Yes. Or are you supposed to be a consumer? No. But that's what people deal with, and most people choose to be consumers. Our savings rate is abysmal in America. This is why you can't retire early. Work hard and invest cautiously, and maybe, just maybe, you'll get a few good years to breathe. To a rapidly growing crowd of young retail investors, it's a ripoff. Okay, so I get that you don't want to do this. Okay, and people feel like, they don't want to spend their entire lives working, and I can partially understand that. Okay, especially because I've had jobs that sucked before, but you're probably not going to retire young. And if you do, you're going to be bored out of your freaking mind. I can promise you that. You need to be doing something. You always need to be moving. If you just retire and sit on the beach, you will get insanely bored and you'll waste away because you have no purpose. On a Friday afternoon in July, some 24 of them gathered in Midtown Manhattan to preach an alternative path, one paved not with paychecks, but payouts. Their mantra: plow money into a host of newfangled dividend-chasing strategies. I like how they keep dividend-chasing. Brutal. And use the steady stream of cash they generate to escape the 9 to 5. Yeah, it's almost like it's too good to be true. Never mind the long-term damage it might do to their portfolios. Ooh, something's getting nasty. So here we have the collection of heroes here. So this is what's his face? My cousin, Retire with Dividends or whatever his channel is. I interviewed him a couple months ago. And then here's the man himself, Jay Pestricelli, or however you say his name. I don't recognize anybody else in this crowd. I'm surprised Khmer didn't get invited. I'm actually really shocked by that. And I don't want to know who this is. Now, I noticed this woman right here, who he's standing very close to, by the way. She has is that an airline belt? Do you see that? What is this? Is that an airline? What is this? Interesting belt, baby doll. You single? Hey, mommy, you single? Yeah. Hey, I'm single too, mommy. Huh? Financial influencers and YieldMax executive. So Jay right here, this is the YieldMax. This is like the head of YieldMax. And this guy is making a freaking fortune. He's making an absolute fortune. YieldMax has attracted billions of dollars of assets under management. One of them was Eli Brees, a 26-year-old former real estate analyst who had put his savings into a dividend-focused portfolio from which he withdrew 40 grand to continue to contribute to the down payment of his home in Tennessee. I don't think it's a good idea to put a down payment into the stock market. Call me crazy, but sometimes stocks can go down and they can go down a lot, and you don't want your down payment tied up in the stock market. Maybe consider, I don't know, short-term treasuries or a savings account. And the dude's 26. Okay, I'm 35. You're 26, bro. If you don't like your job, just get a new job. He has sidelined his retirement account and promotes his strategy to the 217,000 followers on his YouTube channel, Dividendology. Oh, it's a 26-year-old. Beautiful. In Brees's telling, it's all about gaining your freedom. My granddad worked at the factory his whole life. I don't want to lock away that capital until I'm 65. Well, you could just put money into a brokerage account. You could do that. Or you could have a combination of both. You could have some money in a taxable brokerage and some in an IRA or 401k. You can have all of them. Okay. You don't have to lock everything away until you're 65. It's a strange twist. Dividends, once the stodgiest corner of investing, has become the new hot thing with jaded Gen Zers hell-bent on quitting and retiring early. You're too young to quit. Gen Z. I don't even think it's Gen Z. I think it's mostly millennials from what I've seen. But the new playbook isn't just about reliable payers like Coke and ExxonMobil. Those dividends are too low. No, we need big dividends. I want to retire with $40,000, bro. Today's dividend crowd is piling into ETFs offering eye-popping yields generated by complex derivatives. They're actually not that complex. They're just trading options, basically. That's all they're doing. The broad category of income-generating ETFs captured $1 in $6 sent to equity ETFs as a whole in 2025. What? Oh, Lord. Well, I mean, most ETFs generate income. I wonder if they're saying specifically dividend-oriented ETFs. Okay, but this could be a natural thing. A lot of ETFs pay dividends, even if they're not dividend ETFs. Even QQQ has a dividend. It doesn't mean it's a dividend ETF. The most aggressive ones, dangling yields above 8%, have quadrupled in size in just 3 years to about $160 billion. Imagine charging 1% on that every year. 1% every year. That's making billions a year. The craze has sparked a network of YouTube channels and Discord servers. Oh, yes, it has. As well as the R Dividends forum, which I don't know if I'm banned from talking in there. There's a couple Discords that Reddits that I'm banned from posting in, which has grown more than tenfold over the last 5 years to 780,000 members. Go check out Wall Street Bets. This philosophy is one of the many quasi-religious investing movements that has sprung up amongst the young, financially insecure Americans worried about inflation, unattainable housing, and the prospect of AI-fueled economic disruption. Yes, people are terrified and they're struggling, and they turn to these weird cults. Before, it used to be religion, but now that like most of society is godless, now it's just whatever religion you can make up, a stock, an ETF, NFTs, Bitcoin. It's like these little quasi religions. It's weird. It's so freaking weird to me. But that's because the people aren't going to church. They still have that instinct of like community and, divinity, I would imagine. And they choose to make their religion a stock or an ETF. It's the most perplexing thing I've ever seen in my life. Well, I guess, VT is kind of my religion. So, I'm a fanatic. The dividend influencers see themselves as the sober cousins to the YOLO crew. Yes, buying MSTY is totally sober, bro. Closer in spirit to the FIRE movement with its focus on financial independence and retiring early. Financial independence is what you want. You don't want to retire early. Trust me. You may think you do, but that's because you have a terrible job. I've been there, okay? Now that I actually like what I do, I don't want to retire. If you don't like your job, find a new career field. Unlike meme stocks or crypto moonshots, this strategy, what might be referred to as dividends and chill, preaches control and consistently, a monthly drip over flash in the pan riches, not YOLO, just yield. This almost sounds like it was written by AI. The current wave of interest is new enough, and many of the followers young enough, that it has been easy to ignore how the most popular funds have often lagged basic stock indexes and threatened to eat away at long-term returns. Now, I will say some of the YieldMax funds have, in the short term, outperformed the index with a total return. People attack YieldMax, and I've done it before, but what I will say is total return is all that matters. And some YieldMax ETFs have printed a higher total returns than the market as a whole. Doesn't mean they're going to do that in the future, but they have. That's a fact. But a lot of them, the majority of them actually, especially if they're linked to an individual stock, they generally lag that stock. That's the problem. So you basically have to hope you pick the right fund and hope it keeps generating higher total returns than the market as a whole. And we'll see. Samuel Hartzman, a professor of finance at Boston College, get a real job, boy, has researched the issue for more than a decade and has found that investors tend to fall from the free dividends fallacy. Yes, they do. Yes, they do. Treating them in capital gains as separate. Your total return is your dividends plus stock appreciation. That's it. So with YieldMax, you see it going down, and people are like, "Oh, it's going down. It's the worst thing in the world." But you are getting a high yield. So you do have to include the dividends. I will give them that. You have to include the dividends in your total return, even with YieldMax. People don't understand this. I've been trying to explain this for 5 freaking years. A 2015 paper of his finds that investors prone to that bias have a preference for funds that report boosted dividends, even if they don't improve overall returns. Yes, honestly, you should ignore the dividend yield. I'm serious. Think about maximizing total return. That's all that matters. After tax total return. A lot of people think of the dividend as separate from the cash flow. They don't realize it comes at the expense of the price level and isn't making you richer. The stock price drops by the amount of the dividend. That's why YieldMax funds are dropping precipitously, because they're paying huge distributions. But you have to factor in the total return. The appeal of regular payouts has long led investors into stocks and funds that offer quarterly and annual income. Most ETFs do. Christine Benz at Morningstar calls it the psychological pull of the bird in the hand. One of the biggest dividend-focused ETFs, the Schwab U.S. Dividend Equity ETF. Oh, I love how they're talking about SCHD here. Launched in 2011, it is now more than $70 billion in assets with a yield of around 4%. People love SHDA because it has a 4% yield and because in the past it went up a lot. That's why they like SHDA. So they say, oh, if I put $1 million in there, that I can get 40% per year. Well, that's true with potentially with the dividends, but you also have to factor in the stock price appreciation. What if SCHD doesn't go up nearly as much as the total market? Well, in that case, potentially the total market could have a higher total return than SCHD. And that's all that matters. And if you need the money, you can just sell shares. I know, blasphemy. You can sell shares. If you have 2 shares that go from 100 to 1,000, guess what? You got 2 shares that are a total of 2,000. You could sell 1,000 of that, $1,000, and still have $1,000, even though you started with 200. So you still have $800 more, even if you sold that 1,000. Okay, you have 1 share, but that 1 share is now worth $1,000. Okay, and you can sell fractional shares now. That's a thing. Let me reposition this. Okay, I'm paranoid it's going to mute on me. A new, faster-growing generation of funds offers payouts that are much higher, sometimes above 100%. Okay, that's not the true return. Nothing ever yields 100%. It's a trick. Okay, what matters is that you understand how to calculate the total return and whether you think the future total return will outstrip the market. That's it. Take one product operating under the ticker MSTY that is tied to the volatile stock of Bitcoin hoarding company known as Strategy. Yeah. So they got some charts here. In a hypothetical scenario, one investor buys 100,000 worth of the stock of the Bitcoin holding company in 2024. Since then, the firm's shares would be worth $463,000. But if you had bought MSTY with the same amount of money, you'd only have 343,000, assuming you reinvested the dividends, which most people are not. They're taking them out because they think they're income. Roughly $120,000 less. So even with total return, you would have had $120,000 less of total return with MSTY. That's scary. And then last but not least, if you withdraw the dividends, your shares are only worth $270,000, which is $200,000 less than the underlying security. MSTY has massively trailed MicroStrategy in total returns. People are literally sacrificing total returns because they don't want to sell shares. They're so religiously against selling shares that they're going to sacrifice hundreds of thousands of dollars. That's crazy to me. I will never understand that. Oh, but I got more shares than you. Okay, wow. Okay, so but the dividends are the bulk of MSTY's returns. After this investor used the dividend checks to fund day-to-day expenses, all that's left is the value of the ETF, which has now shrunk less to $73,000. Oh, God. The fund has roughly $5 billion in assets and promotes a distribution rate, not dividend rate, distribution rate. A distribution is just money coming out of a business. Does not mean it's a dividend. A dividend comes from profits of about 90%. That's unsustainable. These payouts are generated through a complicated series of options bets. This setup has made the monthly payouts possible, but it has also weighed on the ETF, which has underperformed the underlying company by about 120% total returns since its inception in February of 2024. And that assumes you reinvested all the dividends that it generated, which people aren't doing because they want to use these as income funds. If you pocketed the dividend, as many influencers do, your account would have been left with a security that lags Strategy's return by nearly 200%. God. Changes made since 2019 by the SEC cleared the way for the wave of funds and new asset managers offering massive yields. I have noticed like an explosion of ETFs. It's like, wow, there's an ETF for everything. I think I heard a stat. There's more ETFs than stocks. The Manhattan event that Brees Dividendology attended at the NASDAQ. Oh, I'm so famous. I went to the NASDAQ. Was sponsored by YieldMax, which is responsible for many of the fastest growing products in the industry, including MSTY. The more than 50 ETFs the company has created have seen about $5 billion in inflows. God, Jay's making a fortune, bro. Just since the Finfluencers rang the bell on July 11th. God, who is this? Who is this woman? Oh, God. Does she have any earwax? Let's see. And then here's Mr. Thomas Bell here. You hitting on her, bro? Is this your cheeks? Oh, look, YieldMax stickers. Look at this bald cell, right? Look at this cone head right here. Who is this? Who is this supposed to be? MSTY Mafia. Retire on dividends, Bitcoin, MSTY Mafia. Interesting stuff. Okay, people holding out their phones. Oh, look, they posted me to the account, bro. I'm so famous. And here's your little social hour. Look at this. You got any hotties in here? Let's see. Hey guys, wow. Look at Mr. Gut here. Look at this gut, dude. Never allow yourself to have a gut this big when you're older. Okay, get your butt to the gym. So no hot cheeks, unfortunately. I'm not a big fan of that. Look at this dweeb right here. He's trying to pick her up. Oh, bro. I got so many shares of MSTY, baby. I could take care of you forever. The math these products use: payouts today, erosion tomorrow. Payouts today, erosion tomorrow. Have drawn sharp criticism from Wall Street pros and other people on YouTube who will remain nameless. who warned that investors may mistake current dividends for long-term wealth. If you're taking money out of your portfolio, you're massively dragging your wealth accumulation. One thing that I will pat myself on the back for is I've almost never taken money out of investments. When money goes into an investment, it just stays there. I never take it out, even the dividends. I just reinvest them. That's how you build long-term wealth. You build the money until it's big enough to sustain you forever. That's the goal. But if you keep taking money out of it, it's never going to grow or grow to where you want it to be. Who warned that investors may mistake current dividends for long-term wealth, ignoring how big yields often come at the expense of price returns and overall portfolio growth, because people don't understand total return and how dividends drop the share price. They don't get it. Ben Efert, managing partner of QVR Advisors, has been an outspoken critic of the issuers. They're fooling people into thinking that they're somehow getting income. Some of it is income, but a lot of it is not. And it depends on the ETF. All you're doing is giving me my money back. Who said that before? So the value of the ETF is declining as you're paying me that. YieldMax executives, for their part, are making a fortune. Oh, say they are upfront about what the products are designed to do. Generate attractive yields. It's kind of a sleight of hand what they're doing here. It's kind of dishonest. If you want to just own the underlying stock, own the underlying stock. If you want higher total returns, maybe you should. We're not trying to beat the underlying. We're trying to turn the volatility of these stock into income. Yeah, and I can also sell shares, said Michael Venuto, co-founder at Tidal. People are only trying to get the upside, should not buy YieldMax products. Okay. So then they have a bunch of examples here. So they have the SPY versus JEPI. JEPI's underperformed the S&P 500. Coinbase has underperformed, Coney has underperformed Coinbase by $159,000, assuming you invested $100K. Moderna has actually tracked pretty closely. I think has it outperformed? Or maybe it's underperformed by 2K. C3 AI has underperformed AIYY by 14K. So basically with all of these, you would have less money. And that's assuming you reinvested the dividends. If you took it out, your portfolio would be depleted very rapidly. Still, for investors like Caesar, Ortega, the headline appeal of these amped up products is clear. Ortega, he's 27. Previously cycled through a number of trendy investments sweeping the retail world. He got into options trading and lost $15,000. Well, let me guess, on Robinhood. I've always had what they call the shiny object syndrome. You need to think about that a little bit more, buddy. Think what you're doing. He recently shifted his attention to high yield ETFs after moving to Montana with his wife. He's had a hard time finding a job, so his interest was piqued when he saw the social media posts about the huge dividend payments offered by high yield products. Oh, I can just put money in this product and I just don't have to work? Wow, let's do it. What could go wrong? He began 5 months ago with a $5,000 investment and quickly ramped it up, throwing most of his savings into a handful of YieldMax ETFs, including MSTY. It's just kind of become an addiction. They're addicted to the dividends that are not even dividends. It's a partial dividend and the rest is return of capital. It's a deception. I'm not saying the total return is always going to be negative. You can have positive total returns with YieldMax. That's true. But you're not getting the returns you think you're getting. Now you're seeing dividend funds, the high yield ones, coming up with insane numbers, more like 50%. That just really drew me in to add income while I didn't have a job. So far, Ortega has invested some of the proceeds from the sale of his house and 2 cars. He sold his house and his cars. And about $30,000 in margin loans. Don't ever take debt. Taking his portfolio to $160,000. He hopes this nest egg will generate $9,000 a month of income. Oh my God. So if you take 9,000 times 12, he thinks he can generate $108,000 a year off of $160,000. He thinks he's going to get 67% returns. That's delusional. That is pure delusion. You're insane, dude. While YieldMax has been the most visible magnet, a number of ETF companies have launched into the trend. Income products from firms including Neos Investments, ProShares, and Defiance, I've never heard of Neos, have been introduced over the past 2 years with high fees. Shocker. One of the biggest derivative-based income ETFs is JP Morgan's Equity Premium Income Fund, JEPI, which launched in 2020 and quickly grew to $41 billion. The fund provides exposure to the S&P 500, but generates 80% of its yield via call options. JEPI attracted a lot of money from investors after offering some protection from the market's nearly 20% decline in 2022. If you want to just buy the index, you're going to have to deal with declines sometimes. It happens. But you make your money by buying and holding and reinvesting dividends, and the market is very volatile. In some years, you might have declines, and in other years, you might have explosive returns. And with covered calls, you're capping those explosive returns. But it has still underperformed the benchmark by about 58% points since inception. Dang. That's even for an investor who reinvested all the dividends, which they're not doing. Hamilton Reiner, who runs JEPI, said the goal of the fund is to offer income. Look, just sell shares. Stop. Sell shares if you need to. I'm 100% going to do that in retirement and have zero fear. You need to understand what you're doing. One of the things that's underappreciated about covered call strategies is, yes, you get income, but the options have also helped dampen and reduce volatility. Why do you care about volatility? That's what stocks do. They're volatile. If you don't like volatility, don't buy stocks. Put money in a money market. Put it in a savings account if you don't like volatility. Welcome to the stock market. Many market experts have raised concern about covered call strategies, which can cap upside returns and add tax complications. One guy who calls himself a dividend skeptic says that yield products appeal to investors because they feel safe, but they're typically tax inefficient. And I know that for a fact. I'm a CPA, and yes, I can do your taxes. Book a free consultation below. Expensive myths dressed up as secret sauce. Ooh, dirty. Oh, here he is. Mr. Bell, my cousin. Thomas Bell, the creator of the YouTube channel Live Off Dividends and Options Now, recording at his home in Florida. See, Kid Freshie, he did get interviewed by Bloomberg. You were wrong, bro. Dividend stocks have always come with additional tax liabilities. Yes, dividends are taxable. But most new high-yield products can come with an even higher tax burden because derivatives-based payouts don't get the preferential treatment of qualified dividends and are taxed as ordinary income rates. And they reduce the basis of your shares, so when you sell them, you're going to have a massive capital gain in the future. The space is growing, and one of the things we can always tell investors to do is your homework. It's very important to understand not only what you're buying, but what the tax implication is. Yeah, you'll find out next tax season when I do your taxes. Okay, we have somebody that created a Facebook group called Retire on Dividends. It's everywhere now. This guy cashed out his wife's retirement account and invested the money in various YieldMax ETFs. No, never do that. And other high yield products, but he kept his 401k. He took his wife's retirement, but he kept his 401k. Wow. He still has a day job as an accountant, but he uses his investment income to pay his mortgage, gas, and internet bills and make the monthly payment on his Plymouth minivan. Okay, your account's going to deplete rapidly, bro. You're taking money out of your portfolio. You should be reinvesting. Okay, it looks like he's an ulti. I'm disappointed to see the capital depreciation of 47%. Almost like I'm taking money out. But even with that, you can see how good the income is. But is it sustainable? They do what they can. They produce a solid income. Oh, we got his channel. Man, he got $163 of ad revenue. It's almost 8,000 subscribers. Okay. I'm not knocking it. It's tough to make money on YouTube. Nobody can be as giga chat as me. Thomas Bell, who was invited to the NASDAQ event, says he had watched his father, an electrician, work and save up for retirement without being able to enjoy the journey. When you graduate college, you're like 22. You're young. You have the good looks and all that. I still look good. But you don't have the money. And so it's like, well, how do you get the money fast? You don't get the money fast. The only way you get money fast is building your income and keeping your expenses to a minimum. And over time, your savings rate will precipitously increase, and you will be shocked how fast you get rich just by savings. Bell, who is 35, is this me? Quit his job at Wall Street Bank in 2022. He took a position at a more flexible firm that allows him to work from home and grow his YouTube channel. About 60% of his net worth is in income-focused strategies, including options plays he's put on leverage ETFs. From his portfolio, he generated $65,000 in dividend payouts last year, he says. Well, let me see your taxes. Okay, so then this is basically the end of the article. So, wow, that was kind of savage. That was kind of savage of Bloomberg to do that. What do you guys think? You think that was pretty nasty of Bloomberg? All right, let's do some quick comments. I need to go to bed. I got my kids tonight, and they're going to wake me up at the crack of dawn like they always do. I only do members-only comments. You don't like that? Call a lawyer. Strongman, should I go full port in GME before earnings? Absolutely, bro. You should put it all in options so they can all expire worthless, and you can lose every dime you have. Dividends, W. We can't see your gorgeous figure. Uh-oh, was my picture not showing? Oops. What's up, Pay Pigs? The lady pictured on the right of the Gen Z Investors article is Amy. Bad financial decisions. I need to hit her up, bro. She's very enthralling. Jaded Gen Z. You're too young to be jaded. Okay, I'm 36 this month. I'm old enough to start being jaded. If you're in your 20s, you should not be jaded. Okay, maybe the end of your 20s, but in your early to mid 20s, you're too young to be jaded. You just got in the workforce. Stop. Stop right now. Was just watching There Will Be Red Stuff. Let's get into oil, bro. Should we? It's funny how people in their 20s can't wait. You're too young, dude. I thought the same thing in my 20s because I hated my job. Now that I like what I do, I enjoy it. You hate your job. That's the problem. Work isn't always bad. It can be fun. I'm having fun doing this. I would do this later tonight, but I've got the Rugrats, and they will wake me up early, and I will not be happy tomorrow morning. Cult of the Bussies. I can't retire yet. Oh, yeah. Dude, think how much wealth you could build by not giving me a membership, bro. Think how rich you would be right now if you wouldn't allow me to plunder you every month. But it's worth it. You know it is. Exactly. I need to give my money to That's right. Give me all your money. If you complain about having 24 hours a day for yourself until you die, there's nothing wrong with you. Just slave away for money is the mantra. Well, most people, they slave away because they have to keep spending. The more they make, the more they spend. That's the problem. If you stop growing your expenses with your income, you can save money. It's a shocker. Ryu, what's up, Pay Pig? I guess I'm part of the cult. Yeah, you are a cultist. You're a dirty cultist. Keep Shaddai out of your thick mouth. They mentioned it, not me. If one invested in Shaddai in 2011, they would have now 17% dividend yield without doing nothing. The dividend CAGR is 11%. Yes, dividends come from earnings. You could have bought QQQ, VTI, anything, and the earnings would be massively higher in the future. I was in a strip. Shouldn't have said that. Spending my investment. Bad boy. Great point. Too bad Strongman can't figure out the appeal of that. What can I not figure out the appeal of? Oh, earnings grew. Yeah, earnings have grown in like most companies. Bald cell. Fix the camera. My cousin can't see you. No, I don't know what happened to the camera. I'll be honest. I thought I had it up. Oops. At least you could hear me. Missed the live. I'm still live, bro. What are you talking about? Do you think if the market has a significant crash, let's say 40%, that most YieldMax investors would quit, or the ones that have leverage will be gone? They will be gone. They will be utterly annihilated. Some of them will hang around, and whenever we get back into a bull market, people will come back into it. It's never going to fully go away. I've learned this since the last bear market. You're always going to have clowns. They're always going to be there. When the market crashes, they lose it. They lose everything. They go into hiding, and then when the market recovers, they're back like nothing ever happened. Smart ones would quit. Others will try again. Most will try again. We're all just waiting for Jay Nagy tonight. That's very hurtful, Alan. Okay. You're going to make me cry. Geez, degenerate gamblers. This is bullish for paying off U.S. debt via tax. Why are we running these huge surpluses? It's YieldMax. How is he still making payments on a Plymouth? Those were discontinued 20 years ago. I'm sure he bought it used, bro. He must really suck with money. See, these degenerate gamblers want it all fast. Yeah, everybody wants it fast. Turn the camera on. I don't know what happened to the camera, guys. I'm sorry. I'm really sorry. Anyway, I think that's it for the night, boys. Thank you for tuning in. Like, subscribe. Consider joining as a member to support the channel. I will answer all your comments if you are a member. Also, consider booking a free 30-minute tax consultation with me. I am a certified public accountant. I can do your business and or personal taxes any state in the United States. You can talk to me for free. I'll give you an upfront quote, and I'll prepare your taxes like a boss. Cheers.